When you're ready, sir, let's get going.
All right.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My very special guest today is my old friend Vitaliy Katsenelson. He's the CEO of Investment Management Associates. He's written one of my favorite books on investing, The Little Book of Sideways Markets. That came out a few years ago. We'll be talking about that in a little bit of depth. We'll also be talking about Vitaliy's philosophy on investing, life, and lots of other things. We'll be talking to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Vitaliy. How are you?
Hi, Toby. I'm doing great. It's such a privilege and pleasure to be on your podcast. You have such a great podcast. I'm a big fan.
Well, that's very kind. The privilege is all mine in this instance. I think that you have perhaps the best background story of anybody I've ever had on the podcast. You grew up in Russia and you came to the US and now you're an investor. So can you talk a little bit about what was it like growing up in Russia and how did you get to the States?
Yeah, so I didn't grow up just in Russia. I grew up in a Soviet Russia, which is quite different than Russia today. So I grew up in a Murmansk city called Murmansk, which is above the Arctic Circle, by maybe 150 miles from Norway, but the northern part of Norway. So it's very cold, very long winters, very short summers. Like Seattle looks like a sunshine state. I mean, sunshine city compared to Murmansk. So when I was growing up, I knew very little about investing. I think probably the first time I even thought about investing when I watched a movie with Eddie Murphy, Trading Places.
In the States, or did you see that in?
I think I saw it in Russia when I was still in Russia, and at the time I thought investing was basically what we saw in the movie, trading pork bellies and orange futures, and a lot of people yelling at the stock exchange, whatever, the exchanges. I did not even know that was not even stock exchange then. That was a commodities exchange in the movie. But that's what I thought investing was. So if you ask me in late 80s if I ever going to become an investor, I would have said, of course not. Who wants to do that?
Too boring.
Too boring and too chaotic. And my voice is, I can't yell that much for that long. So anyway, so in 1991, my family immigrated from Murmansk to Denver. And the reason we went to Denver because my father's youngest sister left Russia in 1979 or 1980. And she moved to New York. She was in Brooklyn. And there's a movie, Moscow on Hudson with Robin Williams. That movie basically described her immigration, very similar. And so by that time, she moved to Cheyenne, Wyoming. And thankfully, she invited us to Denver, not to Cheyenne. And so, there was nothing wrong with Cheyenne, but let's be honest, Denver's probably a more interesting place to grow up, to be in. Anyway, so I spent all my American life, which is now almost 29 years in Denver. And so even when it came to Denver, I had no idea what I wanted to do. But at the time, I did not speak English, and I was 18 and a half years old, almost 19. So I went to high school, which is very interesting. In Murmansk, I went to technical college. So I already graduated from high school. I went to technical college. When we came to Denver, I ended up going back to high school because that was the cheapest way for me to learn English. Because the first year when you're in Colorado, you're out of state if you go to local school. So I went to high school, finished high school, and then I went to University of Colorado. And in the first couple of years at the University of Colorado, I dated maybe, 5 or 6 different majors. And I had more majors than girlfriends at the time. And the interesting part was that I really did not know what I wanted to do. And then I got a job at an investment firm, and that they hired me not because of my investment skills, but they hired me because I was good with computers and they needed somebody to help them with computers. And they had a Bloomberg terminal. The portfolio managers there were incredibly kind people, and we're still friends. And at the same time, I took finance classes. I started to take finance classes, and this is when I realized that investing is a lot more than yelling at stock exchanges. I realized that investing is actually analyzing companies. And so the kind of combination of me working for an investment firm and taking finance classes, I realized, oh my God, this is what I want to do. And I was relatively young. I mean, I wasn't Warren Buffett young, like 11 years old when he discovered he wants to be an investor. I was my early 20s, maybe 21, 22 years old. And I realized, well, I'm going to do investing. So for that, I need to do CFA. I need to get my master's degree in finance. And so I had a very laser focus relatively early, in early 20s. And so that was it. That's how.
When did you join Investment Management Associates? Because I feel like it says you joined them as an analyst and now you're CEO. So how did that?
Yeah. So I joined Investment Management Associates in 1997. I think this was I was one class away from graduating from University of Colorado, getting my undergraduate degree. And so here's the story. So that firm that I started was, originally was PVG Asset Management, and they did not need another analyst. So I started looking for a job, and literally what I did, this is kind of early innings of internet. So this when they still had Yellow Pages. I literally went to Yellow Pages, and I faxed my resume to every money management firm in Denver. So the Michael Kahn, who is now my partner, but then was my boss, when he got my resume, he did not even post the job, yet. So I was competing against nobody because it was not advertised. And I think to my luck, I was the only person he interviewed. So if I had any competition, probably I would not get the job.
So he was thinking about posting the job, but he hadn't posted it yet. He needed someone, but he hadn't looked.
Yeah, his analyst left, and they were literally thinking about posting a job, and they haven't posted it yet. And they just got my resume in the fax machine. So I basically spammed his fax machine, right? I sent him my resume, and he interviewed me, and I got hired. But there was a luck element in this, but at the same time, I did send out 200 resumes to people to everybody in Denver. So, there was, some element of persistence on my part.
Were you a value investor at that stage? Had you read Buffett's stuff, or were you still sort of trying to work out what you were going to do?
Oh, yeah. So I knew I wanted to do investing, but I did not know that there are grades of investing. I did not know.
How did you become acquainted with Buffett and value? How did that come about?
So that came actually later in my career than I would like. So when I joined AMA, Mike was a kind of a GARP investor, growth at reasonable price, and he owned Walgreens at the time for 20 years. And I remember at the interview, he was showing me his position in Walgreens. He's like, yeah, I owned it for 20 years, and his cost basis at the time was 50 cents or something. He just bought it and never sold it. He was kind of growth at reasonable price, and that's what he did. So Mike was my mentor, and he's still my mentor. He's still my very good friend, and we have a very good, close relationship. And he basically introduced me to kind of growth at reasonable price investing, GARP investing. And Mike has done a great job managing our clients through the 1999 bubble, because we did not participate in the bubble, and which 1999 was painful, right? Because if you had any kind of discipline in 1999, you would have been left behind. Right?
You guys were still focused on the reasonable price part of the
yes.
growth, not growth at any price.
That's right. We were focused on a reasonable price, and that, yeah. And and Mike is at the time was doing it probably for 20 something years, and he saw that movie before in the 70s. So we stayed out of that bubble, but then 2002 was a very difficult year for us, and this has kind of led me to re-examine our process. And this is where I realized, well, reasonable price may not be good enough. It should be unreasonable, okay? And this is where margin of safety comes in. So this realization made me to explore kind of, first of all, market cycles. And this is kind of when my research into my first book started to percolate. But this has made, also, this is where I started to read more and explore other ways to invest. And this is when I discovered Buffett. So I came to Buffett later than in hindsight, as I would have liked. And this is where I really became kind of little by little. It was like some people say, like they read, they pick up the book, they pick up the Intelligent Investor, and they have this kind of moment, like this slide go on. For me, it was a very slow process. But then then over time I became a value investor.
What's the difference between a growth at a reasonable price investor and a Buffett-style franchise DCF-style investor?
Oh, God, that's a good question. I still struggle to find the difference. I think if you buy a company, so let's step back for a little bit. Okay, let's talk about what value investing means to me now, which has changed over time. Okay, if you and I talked 15 years ago, 10 years ago, I would have told you value investing is basically buying cheap companies, which would basically mean statistically cheap, right? And buying below 10 times earnings or low price to book or whatever, okay? But I realized that's a very primitive way to look at it. And value investing to me is a philosophy, okay? It's a philosophy which is basically, I describe I wrote this chapter for my next book, which if I ever finish it, it will be in that book, but I call the 6 commandments of value investing. And it's basically like the Old Testament has 10 commandments. Well, this one has 6. I didn't want to compete with the Old Testament. Okay, but it's basically value investing is a philosophy where you know all of them, but it's you treat stock as a business, not as a piece of paper or a symbol. You have a long-term time horizon. Mr. Market is there to serve you, not the other way around. You treat risk as a permanent loss of capital, not as volatility. In the long run, stocks revert to their fair value, etc. So this is the 6 commandments. It's a philosophy, okay? And the interesting part, you can apply this philosophy to stocks that may not look statistically cheap, okay? And I'm gonna give you an example. So a few years ago, we bought a company that was growing revenue very rapidly, but was not profitable. It was losing money. And I forget the numbers now, but we basically paid 5 or 6 times sales. And it was Twilio, okay? And I did a write-up on the Value Investor Club. And I basically said, by posting this write-up, you guys are going to kick me out of the Value Investor Club because this does not look like your traditional value investment. But one thing I realized that actually you can apply this framework even to, at that price, I could have applied it to Twilio because if a couple things, the company might have been losing money, but it was losing money because they were spending $100 million in R&D, okay? Right. Which was basically, I'll give you this example, which is really an accounting anomaly. When the Walgreens opens a store, it doesn't get to, it gets to depreciate the cost of the store over a long period of time. If company invests in R&D, it expands on day one. Right. Okay. So if you look at the Twilio and you said, okay, 2 things. First of all, their expenses are really too high because if you amortize the R&D investment over time, actually they would be making money, number one. Number 2, this is a company that has fixed costs. If you are certain the revenues will continue to grow, then the margins, you cannot help but to see the margins expand. So in this analysis, I realized, well, if I'm very conservative with their sales, and at the time we're growing 50% a year, I took them down to 20%, 25%. In 3 years, they would be trading at maybe 2.5 times revenues, which is for a software company, that's actually probably the low end kind of as bad as it gets. So I realized in the worst case, I won't, if I'm very conservative, in the worst case, I won't lose money, which already, so long-term time horizon. So I was looking out 3 to 5 years out, probably 5 years out. There was margin of safety. Okay, and so if you go through the kind of the 6 commandments framework, you can see how a company like Twilio, fits in. We were able to actually fit it into this framework. And it was incredibly successful investment for us. I think the stock went from 25 to it's over 100 today. But again, that's statistically it would not fall into value investing. So anyway, so going back to your question, what is how I transitioned? Well, I started out as looking at value investing as basically buying cheap stocks, and today to me it's more of a framework of philosophy than just doing arithmetic, saying 10 times earnings,
that's cheap.
That's cheap. Yes.
Yeah, I understand the process that you've gone through, and I sometimes think about I think growth at a reasonable price, and you might correct me if I'm wrong about this, but I understand it. You're just looking at dividing the growth rate by the price earnings ratio, and if you're sort of under 1, I think is that you want to be below 1, which indicates that you're getting a sufficiently high growth rate divided by a sufficiently low price earnings ratio that you get. That's a good kind of position. So it's just a simple rule of thumb. Whereas the value the Buffett style framework there's a lot that it's more philosophical. There's more thinking involved in the position. Is that a fair distinction?
Yeah, no, I think that's probably right. I never really, to me, kind of GARP was too limiting.
Right.
Because let me tell you the limitations of that. That it assumes that, actually I wrote about this in my first book. It basically assumes that company can maintain this growth forever.
Right.
Which is usually not the case. At some point, if you grow at 20% a year forever, you become the economy. Or you become the industry. Yeah. So there is so you have to assume that the growth rate at some point will slow down. And I still think in the terms of kind of discounted cash flow analysis, because that grounds me into thinking about business, right? So if company is growing at a fast rate, I do have to make an assumption that at some point this growth will slow down. Otherwise, it will become the industry, right? So GARP, as I start to use it more and more, I start to see limitations of GARP, and this is in part why I transitioned. What made me a value investor, not today I'm a value investor, not just a GARP investor. So yeah.
Sometimes I find it it's funny though that I make that I point out that some of the best investors who I know, who are Buffett style investors, their analysis isn't much more involved than a GARP style investment at the valuation point, because all they simply look at, and they're using some variation of Gordon growth model, dividend discount model, and they're just looking at what are the cash flows this year, what's the growth rate, and what's the appropriate discount rate, and they just use that because all of the work is done on the business and all of the work is done outside of that. They're just simply looking at what is a sort of reasonable valuation for this company roughly, and then I'm going to go and do a whole lot of work and think about where this business is going to be in 5 and 10 years time and so on. So I just think I think that sometimes value investors kind of poo-poo the growth at a reasonable price, but I don't mind simple rules of thumb for kind of figuring out at a very high level whether something is worth considering further.
Yeah, so when it's kind of interesting, when we do an analysis, for every company we own, we build a financial model. And this financial model, the first version of it is going to be, we call it a tablecloth model, which is going to be evident in a second. It's usually it's usually very big. It's usually we go in depth. And if we analyze a drug company, we're actually going to go through every drug and gonna, try to have an opinion on every drug. If it's a drug company, we would actually try to see, okay, when is expiration date? When does the patent expire? And then we can assume the sales will decline by 90%. But anyway, for the drug company, we go one drug by drug. If we analyze in a retailer, we actually can analyze it. We're gonna analyze it on a store level, etc. But at the end of the day, for us, the second model we're gonna build is gonna be a napkin model. Tablecloth napkin.
Right.
And the napkin model is basically, we can only really build a napkin model if we really understand the business, right? Because that is actually, napkin model to some degree, it's more difficult to build because at this point you really need to know the drivers of the business, okay? And the only, we found for us, the easiest way for us to get there is start big and then shrink it. And I know we're gonna talk about this, but if you think about my books, my progression of my books, my first book, Active Value Investing, was 275 pages, I don't know, whatever, 70,000 words, 75 charts and tables. And my second book, which was really the little book of Sideways Markets, all it is, it's my first book compressed into the little book. Okay, it's the napkin version of my first book, basically, right? But I tell you, I could not write the little book without writing the big one, the first one. But at the same time, I'm so much more proud of my little book because, well, first of all, I was given a second chance to, as a writer, to rewrite some things that 5 years later or whatever, 3 years later, yeah. But also, I was able to throw out things that was not as important. So anyway, so the same thing when it comes to building models, same thing.
That's so funny. I did the same thing with mine. I wrote 3: quantitative value, deep value, and then concentrated investing. And I combined them all into one. And that third book is much, much shorter, much, much easier to read, much, much cheaper. But it's probably, in my opinion, it's the best of the lot. So let's talk about active value investing,
sure.
And the little book of Sideways Markets. So what's the thesis, and what are the implications for investors?
Sure. So I got to give you the proper context. So I started to write active value investing in 2005, and that book was actually the instigator for the book was the article I wrote for Financial Times, maybe 6 months before that, where I basically made the case that the stock, if you look historically, first of all, let's break up. Okay, so when you look at the stock market over the last 100 years or so, you've had a secular trends and you've had a cyclical trends. Secular are the markets that last for a long, long time, 10, 15, 20 years. And then you have a cyclical markets that it's a kind of a volatility inside of those markets. So every time we had a kind of long bull markets, long cyclical bull market, the market that followed was not a bear market, but it was actually a sideways market. Because when we think about markets, we usually hear two terms, bull and bear. But in reality, when it comes to secular markets, we only had one kind of a true bear market, which was 1929, market decline, I forget, 70%. But in reality, if you look from 1966 to 1982, the market fluctuated a lot. You had probably 30, 50% declines, but it's just up and down over 16-year period, and it really has not gone anywhere. So, and then usually the sideways markets are followed by bull markets, and then you have that last one was from 82 to 2000. And here is the here's the most important part. The sideways markets or bull markets are not caused by economy. The economic growth historically during sideways markets and bull markets was about GDP grew about maybe 3% a year on a real basis. They're really caused by swings of price to earnings, okay? And in fact, I would argue this. If price to earnings always stayed at 15 times earnings, if this became a law, 15 times earnings, can't go above, can't be below, okay? Then we would basically not have kind of this markets. We would just basically have a very steady markets growing about 3% a year with GDP. Okay. In reality, what happened was at the end of the sideways markets, PE was very, very low, and as the economy continued to grow and PE started to expand, earnings growth was supersized by price to earning expansion. So you had above average returns, and so the problem is the kind of the price to earnings growth is that when you go above average, then when you start supersizing this growth, at some point gets levels so high you can't grow anymore. P gets too high. And then what happens? The pendulum starts swinging the other way. And this is why you have sideways markets again. So it's really all about, these market cycles are really all about just human psychology, price to earnings going from one extreme to another. And that's happening time after time after time. However,
well, just before you go on, I love that idea, and I went and tested that. I went and looked at that independently, and so that what you say, there are these very distinctive cycles, and basically you use Shiller PE or cyclically adjusted PE, and you can find these, and it's sort of 66 to 82 is a sideways market, because the PE compresses over the whole period until in 82 the PE is very low, and then 82 to 2000 is this massive bull market. And there's no real change in the underlying earnings. The earnings are growing at a pretty constant rate through the whole thing. It's mostly PE expansion. And so then this is the thing that I think that most people will be surprised by. You come to 2000, and since 2000, and you say to date, that's been a sideways market where PE's been compressing. Or is that not the case, that we bottom in 2009? Well, how do you use this going forward?
Yeah, so I just realized in 2000, when I was writing my first book, I was basically assuming we're going to have a semi-normal economy, okay? And the economy, like if you look at GDP growth, it was semi-normal. One thing that I did not account for is that we're going to have interest rates going to almost zero or become negative in some part. $17 trillion of debt today actually has a negative yields. If you try to explain to your spouse what negative interest rates mean, good luck, because I can't. Because I would explain to my wife. So it basically means that I'm going to give you $100 and you're going to pay me back $90. And my wife still doesn't understand this, which is logical. But she doesn't. But anyway, normally it's called default. When you pay less, usually default. But anyway, so I think what happened was, if you had a semi-normal interest rates, the price to earnings go from above average to average, through average, stay below average, and then people say, I don't want to own stocks ever again, and this is where basically people give up on stocks, and this is when the next bull market starts. The problem is we never got to this capitulation stage, because the interest rates declined so much that they just poured so much fuel, they poured so much fuel on the market that stock price went up. Stock price went up and never looked back. So I would argue that my little book, or my books are more relevant today than they were even when I wrote them, because we are approaching valuations of 1999 again. So was I right in my thesis? I would argue that I was. But again, I'm describing a framework, right? And it's really, this was not a forecasting. This is, in fact, in my first book, I had a charts and table and saying, okay, I have no idea what GDP growth is going to be, and I have no idea what the ending P is going to be. But if you want to forecast, here's a table, put in your numbers, and you can figure out how long this market would last. But today we're at a very high level again, so it feels very 99-ish to me. So I think my books are as relevant today as they were when I wrote them.
I agree, and I'm not disputing the fact that we're in a sideways market. I just think that we're at the top end of that sideways market, and if we see some of that PE compression, which we could easily see at some stage in the not too distant future, then it looks a lot more like a sideways market if we go down the other side again, because we won't have seen that advancement.
Yes.
You're working on a new book, The Intellectual Investor. Do you want to give us a little taste of what that's going to be about?
Yeah. So just realize, when somebody writes a book, they go to promote it. Okay. So this is one of those books that may come out 5 years from now or 10 years from now. But because to me, it's really, the first book I really wrote it like I had a bucket list item. That's probably the only item I had on my bucket list, to write a book, to make my father proud. My second book was really just, John Wiley and Sons came back to me and said, well, you have the big book. How about you write a little book? I'm like, great. But this book I'm really writing for me. And this is really a book for me before I can tell. So the name of the book is going to be The Intellectual Investor. Okay. And it's a play on the intelligent investor. Okay. So what I'm trying to take it's the next iteration of intelligent investing into intellectual investing, or look at it as basically intelligent investing plus creativity. Okay. And this book is really for me trying to become a better investor, because good thing about investing, you can always get better. You can, and if you don't get better, then you actually get worse. So, this book is for me to get better. So there's a cute story that I read it somewhere. I'm stealing it from somebody, but I don't know from whom. So this woman comes to Dalai Lama and she says, could you please talk to my son? He eats too much sugar. The Lama said, sure, but can you come back in a month? The woman said, sure. So she comes back in a month with her son. The Lama looks at her son and says, stop eating sugar. The woman is bewildered. She's like, I was here a month ago. You could have told me the same thing. He says, yes, but first I had to stop eating sugar myself. So before I can tell others how to become intellectual investors, I probably should turn myself into one. So this is why this book might take a long time for me to write it. So this is, yeah.
So I like that answer. So I like the idea that it's the intelligent investor plus creativity. What's the creativity?
So Ben Graham, if you look at the intelligent investor, it had, and we kind of touched on this a little bit, but there are two things you can get out of it. The recipe, which is buy cheap stocks. And this is what most people get out of the intelligent investor, because it stares you in your face. You don't have to be very smart. 10 times earnings good, 15 times earnings bad, 8 times earnings phenomenal. That's the recipe. And but then there is the philosophy, right? Okay, so my point is this. So when Ben Graham was writing his recipe, he was not competing against computers. He was not competing, he lived in a different world. And if you look at Buffett's evolution, right, he started as a Ben Graham kind of cigar butt investor, and he evolved. And I would argue that you and I are still relatively young, and we have a long runway ahead of us, and we'll be competing more and more against smart investors, but more importantly against computers. If you are only applying quantitative principles, then you are disadvantaged, because if you're only left brain, okay, computers are left brain as well, right? Because it's an algorithm, right? So if you can put, so therefore you're coming to a fight with a knife, and somebody has a gun. So what I'm trying to do is figure out how can I compete in the world where I'm competing against computers. How can I outsmart them? And in my mind, creativity is part of that. And this is probably as far as I'm willing to go right now, because this is still work in progress for me. But this is the why I'm doing this book.
So can we talk a little bit about your investment process as it stands now? So how do you hunt for companies to invest in, and then what's the process after you find them?
Sure. So if you think about our investment process, so the Russell Fuller, right? He talked about 3 sources of competitive advantage. You have an informational advantage, which if you have it today, most likely you're going to end up in jail 90% of the time. So we don't have that, and we're not looking for that. Then you have really analytical advantage and behavioral advantage. I am trying. It's kind of interesting. I think it's often difficult to say where analytical advantage starts or where it kind of evolves into behavioral advantage, because I feel like they are tied together. So analytical advantage for us starts at first from having a long-term time horizon. And I know everybody says this, but for us, it's really when we build financial models, we look 4 years out or longer. Okay, so it's deeply ingrained in our investment process. So for me, it's not just lip service; it's really in part in our analysis. And the reason you want to do this because we're competing against the institutional investors that have external environment shrinks their time horizon. Okay, so that's number one. But number two, you can't really have a long-term time horizon if your clients don't have the time horizon. And so as a CEO of the firm, I have to make a decision that not every client is an appropriate client for us. Okay, so sometimes I have to say no to new clients, which is, guess what? It's not easy. It's not easy. Okay, and sometimes I have to let go clients who are not appropriate clients for us. Okay, and that's not enough. Then you have to educate your clients. There is a tremendous asymmetry of information between what I know about stocks and what my clients know about these companies. I buy a company, and for them, it's just a 3 or 4 letter symbol. For me, we just spend 200 hours doing research. So I write these 20-page letters to clients, 4 times a year, where I walk them through every decision we made in the portfolio, and I say, we bought at Twilio, here's why. And you have a 5-page write-up kind of explaining the business the way we see it, okay? And the reason it's important because at some point we'll be punched in the face. At some point my client's portfolio will decline. But my client's blood pressure, if they read my letters, will not fluctuate much because they understand what we own and why we own it. So that's a long-term time horizon. If you look from behavioral perspective, I have this, I've written about this in the past, and I think it's a great framework. If you think about your total IQ, it's really multiplication of your investment IQ and at times your investment EQ, which is emotional quotient. It's you can say it's analytics times behavioral, right? So the reason it's very important is this. I may understand the company very well, but if I'm not rational why I own the business, it doesn't matter how well I understand it. Okay, so let me give an example. So let's say I have a friend who said that he will never buy grocery stocks, and he never explained me why. But I have a theory that maybe when he was 8 years old, he was caught shoplifting or something. I don't know. But let's say he understands grocery business very well, and his IQ is 150 when it comes to grocery businesses, but his EQ is 0.5. Okay, so remember EQ cannot be greater than 1. So the most his total IQ could be 150. But if EQ is less than 1, then suddenly it starts reducing your total IQ. Okay, so at some point you get punched in the face and you're going to have to make a rational decision. And if you're an emotional wreck, that IQ is irrelevant. Right. Okay, so therefore, Warren Buffett talks about your so-called competence, and you usually think about it when it applies to analysis, but it also apply to your understanding of the business, but it also should apply to your EQ. Okay, yes, I understand the business, but am I a rational investor when it comes to owning this business? So for me, I find that I'm not very rational when it comes to owning low quality companies. When I owning or when I own companies that are whose business is linked very tightly to commodities. So therefore, we don't have them in our portfolios. Okay, because I know my limitations. Okay, so that's where your behavioral edge comes. Also, it's kind of interesting. So when you play chess and you go to the tournament, you really don't have a choice in choosing your opponent, right? So you come to the tournament and you have to play the geekiest guy who only thinks about chess, right? In investing, I can come to the tournament and I say, you know what, I want to play against this guy who works out 6 hours a day and he's here just because he lost a bet. Okay, that's what investing is. I can choose my opponent. I can choose stocks I invest in, right? So if there's an area which I don't understand well, I don't have to invest there. So anyway, so the outcome, so part of our advantage, so when I was thinking about competitive advantage, it's not just one thing. It's long-term time horizon. It's being more rational than others. It's it's doing very deep research. And when we get punched in the face, is actually be able to stay rational. Also, I run a relatively small firm, and I compete against giants, right? And I look at it as an advantage, because we don't have an institutional imperative of creating a portfolio that looks like a kind of Noah's Ark. Warren Buffett calls it Noah's Ark, where you own two of everything.
Right.
Okay. So we are, like most institutional investors today, are forced to, they look, and the consultants look at their portfolio and compare them to the S&P 500 or whatever the index compared to, and say, and so what happens? Institutional investors have to underweight or overweight certain industries, etc. We don't do any of this stuff. We just basically buy high quality companies and we buy them cheap. So I don't have that. We don't market to institutional clients, and we don't want them to be as clients. So we don't have nothing that's, we don't have that handicap in us. Also, we have a research. I have a huge research network. We have a conference every year, Value XVL, and we limit it to 40 people. It's a non-for-profit conference where you have other investors, diehard investors, come and share ideas. And over the years, I was able to build a huge network of people I talk to on a consistent basis. So I have a flows of ideas coming not just from me doing screen or reading Value Investor Club or doing other things. I also get have exposure to a lot of ideas coming from my research network. So that describes part of our process, I guess, but I'm not sure which, No,
that's good. I always, anybody who mentions chess, I always ask what their favorite opening is.
Oh my God. I go back and forth, but I probably just go to E2, E4. So that's at the end. But
yeah, I like that. I like to play the English. We had just had Connor Haley on, and he likes the bird just because it's a very weird opening. But sorry, I interrupted. Keep going.
Yeah. But anyway, but at the end of the day, you want to have a research process which allows you to be as rational as possible. Okay, and that's my goal. I want to be as rational as possible with my portfolio. And because you'll get punched in the face, and then what you do after that, that's really going to determine your returns in the long run.
I want to talk about rationality and irrationality in relation to a particular stock in one moment. But just before I do, just talk to me a little bit about the portfolio. How do you think about sizing positions? Do you trim? How many positions do you hold? What does the portfolio look like?
Yeah, so for me to talk about this, I have to understand who my clients are. I really have two types of clients. People come to me and say, Vitaliy, here's my life savings. Don't screw it up. And so in this case, we would have what I would call a kind of diversified portfolio, where position sizes will go from 3 to 7%, and you're probably going to have 25 positions, okay? And position sizing, and it's going to be the case in both portfolios. The second portfolio I'll discuss as well. But it's basically the higher the quality of the company and the cheaper it is, the larger the position is, okay? And the lower the quality and the less, the more expensive it is, the lower position size. It's all relative. So we would have 7% positions if it's an incredibly high quality company and it's incredibly insanely cheap. Okay, so that's the kind of diversified portfolio. And then I have clients who say, Vitaliy, here is 10 or 20% of my life savings. Please invest it for me. So in this case, I could be more aggressive, and position sizes would go from 7 to 15%. Right. So it's a much more focused portfolio. It's not appropriate for a client for whom I manage all their life savings, but it's appropriate for a client for whom I have maybe 10, 15, or 20% of their total portfolio. So that's how we position size. And one thing that's very important is that we are very formulaic when it comes to position sizes, because we want to control our emotions. It's really, when we analyze a company, we actually, you're going to like this, we have a quantitative process where we figure out, every company, we rate A, B, C, and D on quality. And if it's a company, that at some point it could be 7% position. If it's a big company, it will never be more than 5% position. And so we are doing company analysis and figure out what quality it is, and what discount to the fair value is, and that basically on a formulaic basis leads us to position sizing. We try to keep kind of, because you know how it is. You fall in love. You're like, oh my God, this is the best company ever, and I love it to death. And let's put 20% of the portfolio in it. Well, we don't do that. So when you manage, and this is the serious point, when you manage somebody's life savings, it's an incredible responsibility, and therefore we take it incredibly seriously, because yes, I'm not taking people out of burning houses. What we do is not, I'm not doing God's work. Okay, I get that, but at the same time, when you have somebody's life savings, you're not gonna have any more money. These people, that's all money they're ever gonna have. You really don't want to screw it up. So this is why we are so thorough with our process. This is why we try so hard to be rational. Anyway.
That's a great answer. So let me segue away from that, and let's talk irrationality and rationality when it comes to Tesla.
Oh my God. Okay. So, Toby, I wrote the 30. So I'll start from afar. I bought Model 3. Okay. Okay. And a normal person would just enjoy driving it. And I did enjoy driving it, but then I ended up writing a 37-page article, 11-part article, which people can find on my website. It's everything. So to me, it was interesting because I was blown away how great the car is. I realized, I'm not sure if it's, I realized that electric car is the car of the future. I'm not saying Tesla is the company of the future. I'm just saying I can see how like internal combustion engine cars, what called ICE cars, are basically the horses, and the EV cars and the electric cars are the cars of the future, basically. So, and as an investor, there's so many implications there. So one thing I realized, as an example, that today people think about General Motors, etc., and Ford, and for them it's a foregone conclusion that General Motors will be able to make great electric cars, and that their market share will be the same in electric cars as it was in the internal combustion engine cars. And I would argue that may or may not be the case. Let me give you this analogy. When in 2007, iPhone came out, Nokia, Motorola were the biggest cell phone makers in the world. Okay, and you would think that 5 years out or 10 years out, the iPhone is going to have a small market share, Apple is going to have a small market share, and Motorola and Nokia will dominate it. Well, that's not what happened, right? And the reason for that, because even though iPhone was called had a phone in its name, it was really a smartphone, which is really a computer. So when you went from dumb phone to smartphones, you really went from one domain where the hardware was the most important part into another domain where making phone calls actually was the least important part, right? It's not okay. So, and therefore it requires a very different skill set. So when you made dumb phones, interface was not as important. Software was not as important. A lot of a lot of factors were not that, the factors that mattered in the dumb phones did not matter as much. What also happens when you go from one domain to another, your assets become your liabilities. And this is an incredibly important point to understand. If you had 5,000 engineers that focused on, I don't know, I'm just making this up, on plastic, whatever that is, on whatever the dumb phone's expertise was, those engineers become liability because their knowledge actually weighs you down. So when iPhone came out, Nokia should have looked at Apple and said, Apple, thank you so much, because now we know what the future product is going to be like. Okay, what Nokia did, actually, they took their Symbian, which was a software for their dumb phone, and tried to convert it into a smartphone software. Well, that failed miserably. So it's kind of like General Motors are trying to take their internal combustion engine car and kind of turn it into a hybrid, and you have a Volt and Bolt, and which is none of them were good cars. So my point is this: it's not for today. Tesla is the largest electric car maker in the world. Okay, and another point is very important to understand. The reason Tesla is losing money, not because it's not a good company, it's just because it's very expensive. You need to get to scale, and even at 500,000 cars a year that Tesla producing today, more or less, it's still subscale. Okay, so for General Motors to transition to electric cars, it's going to have to lose a lot of money too. Okay, I think over the last 10 years, Tesla cumulatively lost $25-30 billion. Guess what? That's the General Motors of the world, and I'm not just speaking on General Motors. Just it comes every car company you can think of, they're going to have to lose a lot of money, and that is a lot more difficult than you would think, right? There was a great article about Walmart on Recode, and talking about Walmart's pains of competing with Amazon. Walmart 5 years ago, I think, bought Jet.com, and the guy who was running Jet.com is running Walmart.com today. So Amazon carries 12 million to 300 million SKUs. Walmart store has about 150,000 SKUs, items basically. Okay, so Amazon has 110 distribution centers in the United States. Walmart has, I think, 10 or 12. So for Walmart to be able to compete with Amazon, they need to expand their, distribution network, and they have to, have to start carrying a lot more items. Well, Walmart.com is losing $1 billion a year, and the board absolutely hates it because it's not in Walmart's culture to lose money.
Right.
And so the article describes the kind of the tension between Walmart.com CEO and the board, and they're pushing the Walmart.com CEO to lose less money. Well, the losses come because they're subscale. Okay, and so long story short, if you look at the traditional car makers, it's the transition to electric cars will be very painful, and it doesn't mean that. I'm not saying that they won't be able to transition. All I'm saying is it's not a given that they will all transition well. And if you think about it, yes, Nokia kind of became irrelevant, Motorola became irrelevant, but Samsung today is one of the largest maker of cell phones still, smartphones, even though, so it was able to transition. So some companies will do a better job than others. But to me today as an investor, I look at the General Motors and Fords, and they are to me uninvestable. At some point that may change, but that was another conclusion of the article.
Does that make you a Tesla bull? Does that make you a Tesla long?
That's a good point. So normal person, when he writes 37-page article, he stops. Not me. I wrote another two-part article about this. And basically, this is where it gets interesting. I can see how Tesla could go to, could basically decline 75%. And it's very simple. This is a company that's losing a lot of money. And at some point it may have a kind of a WeWork moment where the markets will stop financing its losses. Right. And then, the stock price would decline. They would have to issue a lot of equity. And if you're equity shareholder, you will get diluted. Okay. So and maybe at some point we get bought out at $10 billion valuation, which would be 75% decline. So I can see that. I can also see how if they're right now they have a run rate about 500,000 cars a year, roughly. At some point I can see how they could be producing 1 or 2 million cars a year, and if they do this, they would have much higher earnings, and then you can see the stock price going up 3, 4, 5-fold. Okay, so I can see both sides. Here's where I struggle. I have no idea what probability to put on each one. So I'm neither bull nor bear, but there was it's kind of funny. The very last part about in my Tesla series, I wrote about tribalism, and this is probably the most favorite 800 words out of 16,000. Yeah, it's almost like a little book, right? And that was actually my favorite part by far, because if you go on Twitter and you type TSLA, which is Tesla, you'll see a lot of people who are raving how much they love the car, like I am, and how much, how Elon Musk is great, etc. And then if you add a Q at the end, TSLA Q, you have Tesla Qs. And basically the Q comes from this. When a company goes bankrupt, you add Q to the symbol. So when GM went bankrupt, I think they added the Q. So this is kind of Tesla bears, right? And so you have this tribalism. You have Teslas versus Tesla Q. You have bull versus bears. And I was thinking about it, like when some tribalism is actually good, right? Like I'm very tribal when it comes to my family. My kids know that no matter what, I'll be on their side. And this came like when we were cavemen and we were in one cave and there were tigers outside. We were a tribe, right? It was us versus them. It's us versus a tiger, right? It's, so that's where tribalism came. And tribalism is probably good in sports, right? My partner, Mike, went to CU Boulder. And CU Boulder and Nebraska don't like each other, And so he had a sticker on his desk a few months ago in August. It said, don't wait till September. Start hating Nebraska now. Okay, that is a true, CU Boulder fan. Okay, and so that kind of harmless, it's very harmless tribalism, I guess, unless you are kind of a soccer fan in Brazil, then it becomes a very different story. And you have tribalism in politics. I'm not going to go there. But when it comes to investing, tribalism is very dangerous because it's really, there is no them. If I'm a bull, if I'm positive on Tesla or on any stock, and somebody has a different opinion, it's not them. I should look at them as my friends because what I should be trying to do is figure out where could I be wrong. There was this great saying by Seneca, time will discover the truth. And so the truth in this case is really fundamentals, right? What will this company's earnings going to be 5 years from now, 3 years from now, what the price to earnings is going to be, and how this business will look like. If somebody has a different opinion from me, and that opinion is derived from doing research, I should embrace it. I should actually try to go out of my way to figure out what they're thinking. So it's not there is no them in investing. So it's not us versus them. And I learned that in Jewish law, which is kind of interesting. When you have a capital punishment case, if a jury comes with unanimous guilty decision, then the person is let go, goes free. Again, I'm going to repeat again. If the guilty decision is unanimous, let the person go, which is kind of counterintuitive, right?
Is.
And kind of, yes. But their thinking is this. If there was not a single person who disagreed,
right,
most likely the decision was not well thought out. Okay.
Right. That's great.
So at IMA, we kind of encourage this, it's healthy debate because again, we're just looking for the truth. And that's what investing is about, really search for the truth to some degree, because again, time will discover it at some point anyway. So we just want to find it before time does. So anyway, so there was this comedian, Milton Berle, who said, I used to be bullish, then I was bearish, and now I'm brokish. Okay, so my point is just don't be tribalish. Right. Then you won't be brokish. Anyway, so that's my kind of Tesla arc.
I like that. I think that's great analysis. That's you make a very compelling argument. Talk to me a little bit about the Softbank WeWork fiasco that's going on right now, and is there a VC bubble? What's the impact of Softbank on the market?
Yeah. So this is actually ended up being one of my most controversial investments, which is we bought Softbank in 2015. At the time, nobody knew what Softbank was. I think when we bought it, my client said, "Why are you buying this Japanese bank?" I mean, really, it's just.
They don't remember Massason from the .com, the first .com boom.
That's right. No, that's right. Well, I guess they didn't. But so yes. So when you were buying Softbank at the time, and this is very important to understand why we bought it. At the time, if you look at Softbank owns some assets. It's owned at the time, it still does, Japanese telecom, which is the third largest telecom in Japan. And when I say third, it's like the market share is maybe a few percentage points behind like number one, number two. So it's still very large at scale, telecom. It owns almost half of Yahoo Japan, and it owns at the time 30% of Alibaba. Now it's 25%. And so if you just literally took the sum of all these three companies and took out debt, you would realize that you were buying SoftBank at the time 50 cents on the dollar. Okay, so
why the discount?
Well, here's the discount. So the reason the discount happened was because SoftBank also bought Sprint. They bought 80% of Sprint, and so the Sprint was still public equity. It was public entity. And Sprint, when SoftBank bought it, they thought they would be able to merge it with T-Mobile. That did not happen, and Sprint was bleeding money, had a $30+ billion of debt. So two things happened. First of all, investors, what they did, they took Sprint's debt and consolidated to, accounting rules say if you own majority position of something, you have to consolidate its debt. Okay, and I see the logic behind it, except Sprint was a separate legal entity. If Sprint went bankrupt, SoftBank would not be responsible for that debt. That's point number one.
So for accounting purposes, it was consolidated, but it was non-recourse to SoftBank. So it would have been bad if they'd lost it, but it wasn't necessarily going to be fatal to the mothership.
That's point exactly. There was another point. If you do the math, if Sprint would go bankrupt, then the value of SoftBank would decline, but it was still significant margin of safety. In other words, even the sum of all the assets I mentioned still was worth more, even if Sprint went to zero. So that was another one. So this was our contrarian view, and we looked at SoftBank, and we thought it's run by a phenomenal CEO. Okay, I gotta explain that everybody thinks Masayoshi Son today is not a genius. I'm going to be kind of, but let me just give you a perspective on him. So when he's 18 years old, he comes to the United States. He graduates from high school in Stanford, I think, I forget, one of the colleges in California, like in half the time. Okay, when he thinks he's 19, he invents a translation computer that translates from Japanese to English or vice versa, sells it to Sharp for $1 million. Remember, this is 1970s, where $1 million was really a lot of money. Okay, and he's not even 20 years old yet. Then he goes to Japan and he tries to figure out what he's gonna do for the rest of his life. Then he realizes that computers are the future. He starts SoftBank, which was a software distribution company. So then he sees the internet is the future, and he starts investing into .com stocks before even .com is on anybody's radar, and he makes a lot of money. Then he does lose his short. Then at some point, in all fairness, he was not responsible for the SoftBank stock being so. I forget what the price was at the time, but it was insane.
It was off 99%, right? Sorry, but you haven't.
Yeah. No. I mean,
this is where it got to at the peak.
Yeah. So it was. I don't know. Maybe it got to some kind of insane valuation and then declined 99%. Right. So the original valuation was too high. Probably decline was probably too much as well. But anyways, he invests in. He survives the bubble. Even though it did decline if you look at the extremes, it did decline 99%. Then he invests. Then he sees that China is gonna, the internet is coming to China, and the commerce is coming to China. He invests in Alibaba, which is probably the best investment ever made. $100 million is worth over $100 billion today, probably more than that. And then he also, and this is where it gets interesting. He sees that if you're going to have a smartphone, the future is in smartphones. In 2005 or 2006, before iPhone was introduced, before anybody had an inkling about iPhone, he came to Steve Jobs with a drawing, which looked kind of like an iPod with some digits on it. Honest to God, and and then he says, Steve, you should make this phone, and Steve Jobs says, Masa, you do your thing, we make phones. But what he did, Steve Jobs, Steve Jobs promised him if they make a phone, Masayoshi Son will get exclusivity on this phone in Japan. Well, the only problem is at the time he did not even own a telecom in Japan. So he goes out and buys Vodafone KK. And he buys it at the time it's the worst run telecom in Japan. For 2 years, he works incredibly hard and he turns it around. Again, today it's one of the best telecoms in Japan. And then he gets, iPhone comes out, they get exclusivity for iPhone. That propels Vodafone, the telecom into where it is today. And so this is the person, and there was, so this is the person who created Softbank. And just realize this, this is, he does not have a flawless track record. He did make mistakes, but he did build a company. He's the second richest person in Japan. Just completely on, he created that. He built a company that's worth $100 billion on his own. Okay, so, and if you look at his investment track record, even if you take out the Alibaba, it's still incredible. It's like 30+% a year over a long period of time. So it's still a very impressive track record. So that's what Masayoshi Son is. So we look at this, we are buying basically $1.50, and we have Masayoshi Son run it. Okay, right. So far so good. So far so good. And so throughout ownership, the discount stayed the same, but the value has gone up. So the dollar became $2 basically because the Alibaba, went up in price, and also in our analysis at the time, Telecom Japan was not a public company; it was still private. So our assumptions on valuation was more conservative than where it's trading today. Because about 6 months ago they took it public, and they took it public at much higher multiple than we were valuing it on our conservative assumptions. Okay, so anyway, so that's so far so good. Then Softbank comes out with Vision Fund 1. Okay, and this is where the bubble, so they were going to commit $25 billion of their own money, and then you're going to have $75 billion will come from other investors. And so I'll be honest, I was never a big fan of this because it's just so much money. So they were basically, so the rationale behind this fund is this. Masayoshi Son thinks that we're going to have a singularity. Singularity is basically where computers become smarter than humans, which I think is going to happen at some point. I just have no idea when. And he wanted to invest in the companies in the early stages that would benefit from this. So the problem is that the private markets it's relatively small markets. So when you have $100 billion kind of infused into these markets, it distorts it. Yes, exactly. And so we were worried about this. But we went back to our models and we said, all right, so what is Softbank worth if that $25 billion they put in is worth zero? Okay, and it was still, the margin of safety was still very, very high. We were still, maybe it would not be 50 cent dollar, maybe it becomes 60 cent dollar. I forget the numbers now, but it was still significantly undervalued. Again, I'm not buying into the bubble. I'm being very conservative in assuming that Vision Fund 1 is worthless. Okay, even though at the time he had a very good return. And then he buys into WeWork. And we look at WeWork and we are stunned because 3 years ago we analyzed a company at the time was called Regus, now it's called IWG, which is basically, they were WeWork before WeWork was WeWork.
.com 1.0 though at WeWork.
Yes. And all you do, you basically rent out, you lease space for, you enter into long-term leases and then you enter into short-term leases. That's, you borrow long-term, you lend short-term. That's how it is. WeWork had that business, plus they also had beer fountains and ping pong tables, and they were losing money. So, but that was basically it. And so I was very skeptical of that. But again, in our analysis, we assumed that Vision Fund 1 is worthless. So, if things blow up there, yes, the stock price will get impacted in the short run, but the permanent loss of capital would not be there. Okay. Then Masayoshi Son announces Vision Fund 2. And if you look at my last article I wrote about this, and if you read between the lines, I was worried because at this point they were going to put in $40 billion into a $100 billion fund, and that money would come from Softbank. So now I'm worried because now you add significant leverage to the company, and also that was my worry number one, and then I already had some trepidations about Softbank, and then when WeWork blew up, and there was an inkling that they're going to put in their own money, they're going to try to bail it out. We sold the stock. Okay, and let me tell you why. So the number one, so remember when we bought Softbank, our thinking was that the discount at some point will go away. So it's just, so it's at some point it's going to start trading maybe 80 cents on a dollar or 90 cents on a dollar. Okay, here I see that if they start bailing out, WeWork, the bailout is not going to come from Vision Fund, it's going to come from Softbank. So suddenly Softbank debt balance sheet will balloon. That's number one. Number two, the Sprint, when Sprint and T-Mobile merge, the debt will migrate from Softbank's balance sheet to T-Mobile's balance sheet. And my thinking was that at some point they'll also Sprint, and they're going to have a very good balance sheet. Now I start seeing that, well, this may never happen because if the WeWork is going to become a sinkhole for the capital, that debt will continue to stay high. And now I realized also that, well, if they put money, so another risk is that Vision Fund 1 may never happen in the way they envisioned it originally. And the Softbank is going to have to put in more money of their own money. So I realized that this company will never kind of have a clean balance sheet, and that discount may remain permanent. This is when I realized, okay, well, we're going to sell the stock, and then we'll watch from the sidelines. If Masayoshi-san is a very smart guy, if he reshuffle things, changes his strategy, etc., we might come back and buy it later. But at today, I can see how, yes, discount is there today, but the risk is that the value will decline in the future because debt will go up, and then discount actually will never narrow. So that's why we sold the stock. And so here's the interesting part about VC bubble. So just think about this for a second. I'm the person who, and I wrote this article about VC bubble because you do have a .com 0.2 bubble is happening in private equities today. Because if you are a startup and you have a venture capitalist giving you $10 million, let's say, I don't know, let's say give you $1 million at $10 million valuation, they give you this $1 million and say, grow. So you take $500,000, you hire engineers, you take another $500,000, give it to Facebook and Google, and start advertising. At this point, you're not really focused on profitability. All you want is growth. 6 months later, you have a round B. Now you have larger revenues. You're still losing money, and you've been valued at $100 billion, and the venture capitalist gives you another $10 million. So you spend some of that money on hiring more people and creating a product, and a lot of that money goes to Facebook and Amazon's and Google's, etc. So what happens is this, that you have a bubble develop because you've been valued on revenues, and profitability is not really important, right? The only problem is you're going to have this WeWork moment happening where markets, so because you're losing money, you always rely on the kindness of strangers, and you always rely that they're going to be a greater fool, going to give you more money in the future. At some point, you're going to run out of greater fools, and then you're going to have a bubble burst. So imagine I have this mentality, and then Softbank is one of the propagator, the instigators of the biggest bubble. Softbank is actually blowing up this bubble, and so you do have this conflicting thoughts, right? And the only solace we had is that I can ring-fence Vision Fund 1. I can say, okay, this thing is zero. There is still, the rest is still worth a lot more than than where the stock is trading today. But anyway, so that's kind of I feel like also I'm maybe partially responsible for WeWork bubble because I wrote so many positive articles about Masayoshi-san, and maybe he read them, and maybe it just, maybe it went to his head, and he's like, well, I walk on water, so anyway, so
I really am a genius.
yes, yeah. Well, I think this is kind of this is very important lesson, not just for Masayoshi-san, but for everybody. The market is such a great humbling machine. If you feel you're great, just wait 6 months, and the market's going to tell you, it's going to bring the your self-esteem down a little bit. So,
I couldn't agree more. Vitaliy, I'm sad to say that we're coming up on time. It's absolutely flown by chatting to you. If folks want to get in contact with you, what's the best way of doing that?
Yes, so they can read my articles on contrarianedge.com, contrarianedge.com.
We'll put a link to that in the show notes as well.
And we have a podcast which is not as great as yours, and it's not even a podcast. It's really kind of articles on tape. It's just when I write articles, you can listen to them read to you by a professional narrator, so you won't have to listen to my voice.
That sounds great. I should get that for my podcast too.
Yeah. And just go to investor.fm, like FM radio. So and you can listen to them there.
Got it. Vitaliy Katsenelson, thank you so much.
Toby, it's my pleasure. Thank you very much.
And that's it.